So welcome to this recorded presentation comprising of a video by Philip, and then what I expect to be a lively panel discussion afterwards with Bill, Philip, and Luke around scenario analysis for operational risk, and also the hot topic of the moment, operational resilience, which is also relying to a large extent, or has a large input from scenario analysis. So this event is on behalf of the IOR, the Institute of Operational Risk England and Wales. My name is David Goodyear. I'm fortunate enough to have become chair relatively recently, taking over from Jimmy Hinchliffe. So a big thank you to Jimmy. This is my first time out without stabilizers, so I'm hoping it goes well. If I just look at what we're trying to do today, so just a very brief introduction, a little bit on scenario analysis by myself, then Philip to introduce his video, which will then be on the key impact deep dive analysis. And after that, there will be, as I've mentioned, the panel discussion. And then in the final few minutes, I'd just like to give you some information about the IOR and why it's doing some really great work. So first of all, if I could ask each of Philip, Bill, and Luke to just briefly introduce themselves, that would be great. Thank you.
Okay, thank you. So I'm Philip Umandi. I'm currently head of operational risk capital at Lloyds Banking Group. Prior to that, I worked for the UK financial regulator, and I have many interests, including ancient history, theology, philanthropy, Formula 1, and football.
Okay, we should explore some of those in more detail later, I think. Bill?
Hi, I'm Bill Sterling. I'm currently a contractor working at the London Stock Exchange Group, focusing on operational resilience. In my long background, I've spent about 14 years focusing on operational risk and now operational resilience, covering many banks, building societies, insurance, asset management, and now effectively financial market infrastructure. I will scare people if I tell you what my interests are, so I'm going to wait for questions later.
Thanks, Bill. Over to you, Luke.
Thanks. I'm Luke Karovic. I'm Director of Research and Information at OREX. So for those of you who don't know, OREX is an industry association. We are around a little over 100 institutions, typically banks, big banks and insurers taken across the globe. But we exist really to support operational risk management in those organisations, so pushing the discipline forward. We're known for doing things like data sharing, but we do a whole range of other activities now, and very happy to be on the panel today.
Thanks, Luke. So maybe if I can just spend a couple of minutes around scenario analysis and just trying to remind ourselves actually why we're doing this in the first place, because it is actually extremely important. Getting interest and buy-in from senior management, I think, can at times be challenging, especially around some of these maybe more extreme or more severe events, because in many ways, you know, they don't want to think it could happen on their watch. But I think it needs to be realistic. I think management buy-in can be achieved, hopefully through good communication and their understanding of why it's necessary. So maybe looking at the outputs on the right-hand side, first of all, kind of identifying vulnerabilities. So I think everybody has an interest in this as to why things might go wrong in certain scenarios, what you can do about it, you know, how you would respond, which could be through your incident management, your crisis management, but what actions would you take to remedy the situation? You know, also, are you remaining within what might be your risk appetite or your tolerance towards these events? But perhaps some of the more important things at the end are around, well, you know, what are potentially the causes, what events could they lead into, and then what are the impacts from those, which can help you identify the control weaknesses, and most importantly, remedial action. So, you know, if you do find an issue, if you do find a vulnerability where you're outside where you want to be, your appetite or your tolerance, you know, what actions can you sensibly take to bring yourself back within that? And then really on the left-hand side around maybe some of the inputs, so, you know, brainstorming, getting the right people around the table, being non-judgmental. Well, certainly in my life, I like to think one crazy thought can give rise to a more constructive thought, can trigger other thoughts. So, you know, not shouting people down, not criticizing, avoiding groupthink and maybe dominant personalities is a big one. I think one way of doing this is actually to get people to write things down in isolation, so that they're thinking for themselves rather than being influenced by others. And then you've got good data. You've got, you know, information from your risk and control self-assessment, potentially, you know, losses you've incurred or external losses, events, news stories. And as maybe Luke has just mentioned there, you know, there are scenario libraries available externally as well. So at this point, if I could maybe just hand over to Philip, and Philip could introduce the video, please.
Sure. I first want to just say thank you to Digital Operational Risk for this opportunity to share my thinking around, I guess, taking a different perspective to how we can assess threats to a business. In this video, I introduced the concept of a key impact deep dive, where the idea is to focus on business discussions around the impact of a threat rather than what caused the impact to happen in the first place. And there are some parallels with how the regulators are asking us to think about operational resilience, in that you assume an impact will occur. And the question is more, how severe could that impact be? In this video, I will talk about using a key impact deep dive to assess extreme operational risk impact. In other words, those that pose the biggest threats to your business strategic objectives. And I touch on how this approach can also be used to assess capital under the Basel framework. And a key impact deep dive goes hand in hand with RCSAs and scenario analysis, and it doesn't require the use of sophisticated models, although there is scope to use such tools to the extent that your organization finds it useful to do so. So with that, I hope you enjoy the video.
I'm going to spend the next few minutes telling you about an approach for assessing extreme operational risk impacts in a way that is simple and transparent to your business. The approach is based on undertaking a key impact deep dive, and it leverages some key components of an operational risk management framework that you no doubt already be familiar with.
The threat landscape for the UK financial sector remains challenging. We are currently going through turbulent times, navigating the challenges posed by a pandemic that has been and continues to cause devastation across global communities, within the backdrop of evolving social, customer, and regulatory expectations, geopolitical tensions, climate change, and economic uncertainty. For centuries, all organizations have needed to face up to a number of operational risks, with perhaps some of the oldest being the risk of being unable to access premises due to natural disasters, civil unrest, or terrorism. However, the immense pace of technological advances, tightening of data regulations, and as many firms increasingly offer services and products through digital channels, the threat landscape has inevitably evolved, and many of us are still learning how best to manage some of the risks that have become more prominent over the years, such as those related to cybersecurity. No matter what sector your business operates in, the need to manage operational risk has perhaps never been so great. As you know, operational risk events can not only cause harm to your customers, colleagues, and reputation, but they can also in some cases pose a serious threat to a business's financial stability. Therefore, best practice risk management undoubtedly compels us to invest time and effort into assessing the potential financial impact of extreme events and the associated probabilities. This activity can help us decide if we wish to mitigate the risk in some other way, such as through the purchase of insurance, or inform our decisions as to whether we should scale back some business activities or distribution of certain products. I would like to tell you about an approach for assessing extreme operational risk impacts in a way that is simple and transparent to the business. The approach is based on undertaking a key impact deep dive, or KIDD. The KIDD is based on focusing on an impact type, and the approach can be applied to any type of impact, for example, number of customers, IT outages, or indeed reputation. However, in this briefing, I'll focus only on its application to financial loss types, and hereafter I may just say loss type for brevity. Application of KIDD to financial loss is built on a premise that extreme operational risk losses tend to be driven by a single large event. For example, a misconduct event following the mis-sale of a product, or as another example, a major fraud, such as the case for a number of banks, with perhaps one of the most famous being the case of Barings. Furthermore, the second crucial assumption behind the KIDD is that operational losses are driven by a small number of loss types. For example, the Barings fraud loss was driven by market risk losses, while customer redress, perhaps coupled with a regulatory fine, would be the loss types following a mis-selling event. Up until recently, the advanced measurement approaches has been seen as the banking industry standard for assessing potentially extreme losses arising from operational risk events. The AMA incorporates a number of components that are useful for risk management. For example, requirements for loss data collection, scenario analysis, and consideration of the business environment and internal control factors. However, there are a number of limitations with the way in which the industry has tended towards implementing the AMA. The limitations relate mainly to the need to assess extreme operational losses using a statistical model. This has led to the Basel Committee on Banking Supervision to scrapping the use of AMA for setting minimum capital requirements for banks. Although not explicitly mandated by Basel texts, banks have converged towards adopting a so-called actuarial approach for modeling extreme operational risk events, and this has been explicitly mandated under regulatory technical standards for banks using AMA in the European Union. Model outputs produced from the actuarial approach typically represent aggregate amounts a bank could lose from multiple operational risk events occurring in a single year at the 99.9% level of confidence. A limitation of the actuarial approach is that it does not easily lend itself to providing insight into the drivers of operational risk losses. Sensitivity analysis and in-depth technical analysis of actuarial model outputs can be used to gain some insight into the business's most material risks. However, this sort of analysis requires technical expertise and is generally not accessible or easily explainable to non-technical business colleagues. Moreover, the analysis is not able to provide detail of what element of the business key risks are driving the loss. As an example, it may be apparent from the modelling that cyber risk is a material risk for the business. However, model outputs from the actuarial approach will not provide insight into what specific elements of a cyber event would be the most impactful to the business. For example, it could be customer redress, regulatory fines, loss of future earnings, or deposit outflows. Consequently, the quantification of extreme losses under the AMA has generally been difficult to articulate to business senior executives and non-technical stakeholders. Unsurprisingly, the term black box is often used to describe current operational risk models. The operational modeling concepts can at times leave the business perplexed and lead to less engagement from the business when it comes to conversations relating to assessing extreme operational risk losses. This is despite these posing a serious threat to financial stability, as we have seen from several historical cases and more recently by the COVID-19 pandemic. A further limitation of adopting the actuarial approach for modelling a broad set of operational risks is that they typically assume losses are unlimited and can exceed a firm's balance sheet. The assumption is possibly a reasonable proxy in some cases. For example, operational events that lead to market losses, fines, or loss of money from fat finger errors. However, it is particularly flawed for risk events that result in damage to tangible assets and customer and product related issues, given the bank has a finite number of buildings and customers and has distributed a finite number of products. The key Impact Deep Dive is a framework for assessing severe risks in a way that is simple and transparent to the business. It does not rely on the use of any sophisticated models, and it is analogous to and leverages a typical risk and control self-assessment process. But the key difference being that the focus is on assessing the most material business loss types instead of the risks that could cause losses to occur. The rationale behind this construction is that if an institution experiences a significant aggregate loss, for example, over a 1-year period, then the aggregate loss will be driven by only a small number of loss types. Approaching the extreme loss assessment in this way enables business subject matter experts to focus on analysing just a small number of loss types, potentially freeing up the business resources that will be used in attempting to meticulously quantify tens, if not hundreds of scenarios or risks that could crystallise. The key impact deep dive approach steers the business towards focusing on assessing, gaining a deeper understanding of, preparing for, and mitigating the impact of loss types, which are considered the most harmful to the business. As well as example, a bank might have a number of risks that have customer rectifications, for example, redress, compensation, refunds, and so on, as a key driver of the financial impact. For example, resulting from mis-selling, bad advice, IT outage, cyber and data-related incidents, and so on. Rather than requiring the business to attempt to quantify each of the risks in detail, the KIDD approach requires the business SMEs to undertake a detailed assessment of a severe but plausible customer rectification outcome in a more general sense, i.e., regardless of the operational risk events that have resulted in the customer rectifications. The assessment might include, for example, a detailed analysis of customer base, internal policies and procedures, value, volume, and mix of products, and will likely incorporate consideration of both internal and external loss incidents. It is possible that a bank would experience multiple material impact types over a given time horizon. By mapping risks back to impact types, a firm can determine which impact types could plausibly occur simultaneously. For example, a cyber-related incident could result in both material customer rectifications and hefty fines from the regulators. As another example, a major natural disaster could have an impact both on the bank's branches, offices, and call centres, i.e. damage to tangible assets, and at the same time have an impact on the loan book, i.e. following impact to residential properties and the broader economy, and therefore resulting in customer rectifications relating to loan defaults. The key impact deep dive approach has the advantage of being broadly immune to the granularity conundrum, i.e. the challenge of deciding how many risks or scenarios is the correct number to assess and aggregate across an organization. Furthermore, the issue of unknown risks is less of an issue under the proposed approach. The firm is only required to consider a fixed set of key loss types, and this list would only be likely to change and require review if there is a significant change to the organization's business model or the external environment that the business operates within. The key loss types will likely vary across sectors, albeit there might be similarities and some read across for certain business models. Furthermore, an organization with an embedded operations management framework will already have an established set of terminologies that works for their business. Therefore, I'm not necessarily advocating the use of any particular taxonomies. However, for the purpose of explaining the approach, I have adopted the taxonomy used by the Basel Committee on Banking Supervision, as it is widely recognized and understood in the banking sector, and indeed other sectors outside of banking. The KIDD approach can be summarized via the following 5 steps, which will be completed post an RCSA activity. Step 1. List the key impact types for your business that could result from an operational risk incident. Step 2. List the impact type severity drivers. Step 3. Map the impact types to the key risks you have identified for your business. Step 4. Assess a severe but plausible loss amount for each key impact type, pre and or post mitigation. Furthermore, attach a likelihood to the loss amount, if this is of business value. Finally, step 5, the potential extreme aggregate loss follows from considering a combination of the key impact types assessed that could plausibly simultaneously occur. An example of impact types a typical retail bank may have are customer rectifications, for example, product refunds, redress, compensation or goodwill payments, and customer loan defaults, whether intentional or unintentional, market losses, for example, due to interest rate movements, fines and legal settlements, for example, following class actions from investors, employees, or customers, loss of assets, for example, funds being lost following the transfer of money to the wrong recipient, and damage to tangible assets, for example, from branches or offices being flooded. And finally, operating expenses, for example, the cost of deploying additional headcount, contractors, consultants, legal advisors, suppliers, or new systems and technology to manage an issue. Steps 1 to 3 follow easily from activity you will already be undertaking as part of your established operational risk management framework. However, some might find step 4 quite challenging. So let's take a look at an example of how this might work in practice. Suppose you would like to assess a severe but plausible loss amount for the loss type damage to tangible assets. The natural way to think about this would be to consider what are the business's most valuable physical assets, be it machinery, buildings, vehicles, and so on. If it's buildings, then you'd focus your assessment on buildings. And depending on the size of your institution, you might take one of the following approaches. A simple deterministic approach where effectively the loss amount is simply the value of your most valuable building. So essentially the assessment is based on the cost to your business if you lost your most expensive building due to a fire, flood, terror attack, rioting, or something else. The cause itself at this stage isn't really that important. It doesn't matter how or why you lost your building. The focus is more that it's being lost and what's the total value. If your most valuable building is worth £1 million, then that would be your answer. If you're a medium-sized firm, then you might want to take the analysis a step further by considering a cluster of buildings, i.e., what would be the cost to the business if 2 or more buildings within a certain radius were to all be destroyed at the same time, or within a given time period. Finally, a large sophisticated firm might run a so-called simulation engine approach that considers multiple locations, a varying radius of impact, and impact curves for each building. You may also wish to, or indeed need to, assign a probability to your loss assessment, depending on how you want to use your analysis. For example, if you're doing a stress test, deciding risk appetite, or assessing economic or regulatory capital, then this is something you will likely need to do. Assessing a probability of infrequent events is of course extremely challenging. In the absence of sophisticated models, a business has few options, with the most accessible being business judgment informed by any useful information the business can get hold of. For example, when considering what damage to your buildings, you essentially need to consider what events could plausibly lead to your building being completely damaged, and what are the combined chances of one or more of these events occurring. To inform the business judgment, the business might look to government web pages for flood probabilities, and there might also be websites that provide an indication of the terror threat and other risks. You can of course also look at internal and external loss data. Once you have done a severe assessment for each loss type at the same probability level and of course same time horizon, you can simply then add them together to get your overall extreme threat level. This could represent the amount of capital you need to hold. A more sophisticated firm might take this a step further and consider the most severe loss types that tend to materialize together. For example, mis-selling results in customer redress, fines, and operating expenses. Review of historical loss data, key risks, and consideration of macro risks such as climate change can help you consider which loss types tend to happen together. So the Key Impact Deep Dive is an additional item in our risk management toolbox that can help us to assess severe operational risk events in a way that is simple and transparent to your business. And it's based on starting with and focusing on an impact type. I've given an example of how it can be applied to financial loss. However, the framework can also be applied to other impact types, such as number of customers, length of IT outages, or indeed reputation. As data and analytical capabilities evolve, some firms may eventually explore the notion of real-time assessments, and perhaps the concept can eventually be extended to other risk disciplines too.
I hope you found the briefing both useful and interesting. If you have any questions, then please feel free to get in touch with me on my email address, which is philipyamandi@hotmail.com. In the meantime, take care and stay safe.
So I'd just really like to kick the panel off, and if I could address the question to Luke to get this going, and then hopefully we can get a good interactive discussion on the move. So just from your perspective, and I think you have quite a good view across the industry, how are you seeing scenario analysis practice actually evolving across banks and financial institutions at the moment?
It's a really good question. I'll try and keep it relatively brief. I could probably talk for an hour on this, but it's probably worth sort of seeing where we've come from to see where we're going a little bit. And certainly with the banks that I interact with, and they're mostly banks, they're mostly big. So for them, scenarios were really a big component of AMA, so the advanced measurement approach. And a lot of what they did was entirely aimed at producing scenario output for that process. And I think, although when you look across the globe, actually the role of scenarios within AMA models was incredibly diverse. You ended up with processes that were very specific to that particular model. In the US, scenarios very different to scenarios in Europe. And I think with the advent of the AMA going away, everyone thought that scenarios would dry up because they are quite a costly thing to do. But actually, we've probably seen the opposite. There's increasing interest in them. And the two directions that people seem to be going in, to kind of tee up the discussion, we're entering a kind of phase that we call framework optimization. And within that, there are two things going on. The first is that people are starting to think about scenarios in a much more structured way. So they're looking to use things like risk drivers. So at the very start, people used to get in the room, do an estimate about what's the worst rogue trader we could have. Let's all write down the numbers to the average. But people are starting to do that in a much more systematic way. So in that case, they would think about the things that actually contribute to the loss if you have a rogue trader, for example. And by doing that, you create a much more transparent process, much more repeatable. You could scale it, you could transplant it into a different setting and still have a good output. So people are just getting a lot better about being more structured. The other thing they're doing is that they are starting to use triggers a little bit more because scenarios can be costly. So rather than just simply going back every year, refreshing the same storyline, you get a lot of people coming back saying, we did this last year, nothing's changed, why people see it again. Using triggers to say, actually, some of those drivers have changed, the exposure has probably changed, we need to sit down again, think about what that means for our scenarios. So much more structured direction things are going in. Ultimately, where people would like to end up, I think, is scenarios being used for risk management purposes. So again, any kind of regulatory reasons, stress testing, capital, I think actually doing scenarios because it's really good for your bank to do that. And we saw a little bit of that in the pandemic. A handful of banks sitting down doing very rapid scenario analysis to understand whether a decision they were going to make would have a positive or negative impact. But I still think it's quite a long way off that becoming a kind of BAU activity where operational risk is engaged regularly just to do some scenario analysis for kind of strategic purposes. So the big takeaway for me is breaking down that scenario into drivers, the cost components, the things that really matter in that storyline, rather than just trying to do it in a fairly kind of ad hoc. The people used to say sort of expert driven, often shorthand for saying people came in and just told us what they thought, rather than having a more structured way of doing it.
Okay, thanks, Luke. I think that's a very nice summary, and I think encouraging in many ways. So Philip, so what's different about KIDD? How does KIDD complement this? How does it augment, perhaps?
Yeah, thank you, David. So, well, first of all, I want to stress that the Impact Deep Dive is an additional tool in our risk management toolbox that can be used in parallel with RCSAs and scenario analysis. The difference with Impact Deep Dive is it doesn't require you to focus a lot of time on quantifying a large set of scenarios in order to get an understanding of how much your firm could lose under severe but plausible circumstances. So instead, you just need to focus on quantifying a small number of impact types, and they can free up that time to focus analysis on understanding what could go wrong and whether you have the appropriate controls in place. So a bit like what Luke was saying around the kind of using scenarios for risk management purposes rather than for quantification purposes.
Okay. And Bill, so from what you've heard so far, I guess what's your initial thoughts, impressions on that?
I like the concept of KIDD and also picking up on Luke's description of the trends he's seeing across the industry. I think both of those resonate with me in that I've seen elements of them in action over the past few years, and I am an advocate of having rules of the road and a bit of discipline around how you structure your scenario development and then assessment. And really the assessment part is where I can see the Key Impact Deep Dive coming into its own. And in one of my recent engagements, it really is precisely the approach that we deployed. At the back end, there was a sophisticated model that cranked out the numbers, but actually for the business leaders and the practitioners to make things sensible, they absolutely got if you limit the number of impact types, keep it quite disciplined, that we're not talking about 10 years loss of future income. We're talking about impact here and now, or the impact in the next 12 months that derives from the event, and then scale that with your product data and your customer data, and really come up with a fairly educated approach to calculating whether something is this is a severe scale event or is a very pessimistic scale. And once you've got those parameters defined, actually then recalibrating the level of losses, recalibrating the capital requirement, just recalibrating the sort of the scale of the threat to the organization becomes relatively straightforward. And back to Luke, actually repeatable year on year with a health check to say, is this actually still a valid suite of scenarios? Is this still a valid scenario? Have we got the right drivers in place? So you've got relative stability, scalability from the drivers, and actually things that business people can understand, because they understand that the numbers of customers you're talking about, the size of the book you're looking at, and so forth. So I support this direction of travel, absolutely.
Okay, and actually I think you pick up an important point at the end there about getting the business buy-in, because again, I think we've all experienced the reluctance of people that they're busy, they're wanting to be making money sometimes, so why would they take time out of their schedules on something like this? So I think that certainly resonates, that this could really grab their attention. It's simple, it's quick, relatively quick and understandable. But then I think also kind of that, do you think that senior management presentation, when you get up to whether it's the risk committee or the board, and you're giving the summary of the results, again, I suspect we've all been there, where you see them immediately turn off the second you open your mouth, because they're really not particularly interested in what's coming next. It's a thanks. Hope it doesn't happen on my watch, and if it does, we'll do something about it. So again, do you think, and this is an open question, do you think this will really help boards engage, senior management engage?
I really hope it does, David, and that's kind of one of the big intentions in the way this KIDD is constructed. It's thought up in such a way that the conversation becomes more about, as Bill was suggesting, about your customers, the size of your mortgage book, and so on and so forth. And it's less about, look at this curve, look at some historical data I've got, and what is the loss at the whatever 99.9% level, etc. So it becomes more a business type conversation when you're thinking about the kind of extreme impacts rather than a kind of arcane modeling conversation, if that makes sense.
Yeah. It's a real world conversation.
Yeah, if I come in a little bit, apologies, Bill. I can completely agree with Philip. I think because with a sort of traditional LDA sort of model, extrapolating to large things, you're essentially saying, well, we've had something very big, so why not? Why couldn't it be bigger? Why couldn't we go further into the tail? Whereas the discussion is different here. It's extrapolating from the current position of this is the number of customers we have, these are the products we sold. Imagine if we'd got it wrong, and you scale that up, and then we all have to pay them all this compensation. It becomes a lot more real and believable, I think, rather than some kind of just extrapolation of a curve, essentially. The other thing I was going to add, which I think is really powerful in the methodology, which is working back from the impact, is that the thing that we've noticed has changed in operational risk broadly in the last, say, 10 years is that people are now worried far more about other impact types, not just financial. So they still are interested in financial things, still makes a huge difference, but reputational damage particularly. So when you look at the impacts people are considering, that's the bit of the kind of taxonomy that has changed the most for me. And this works very well with that, because you can work backwards from any type of impact. And I think it's quite hard to get to reputational impact when you're starting from that kind of risk and kind of mindset is a little bit more challenging. So it's definitely the way to go, and I think it fits with resilience, as Philip said. It's a bit like reverse stress testing as well. You're starting from a bad outcome and you're trying to work out how did we end up getting there. So I think it's great.
Okay. I think we've all mentioned operational resilience, which makes perfect sense. The final policies have just been published. And there, I think, as Philip mentioned, you find yourself in a situation, you don't have to worry how you got there. It's just, you are there. This is what are you going to do about it? Are you beyond the tolerance that you set? And I guess looking at this from the customer perspective, of intolerable harm, or you're also looking at, on the firm, so the viability of the firm, or maybe for larger institutions, their systemic impact. So do you think this is a really timely, I would say a timely time, not great English, but is this a good time for KIDD? Is this, really arising or being discussed at the right moment to complement or maybe to help solve some of these issues people are going to have in implementing operational resilience?
Yeah, I think it is, yes, and it neatly fits into the zone, between, and I'll put that a traditional business continuity approach to scenarios that will create business continuity, requirements, and the quite technical financial capital requirements that are driven and demanded by the regulators. This is certainly the push from the regulators and the Basel papers is very much on a practical basis, so that you develop scenarios that actually you can envisage impacting on, as you said, David, customers, stakeholders, viability. And you don't need to calibrate those particularly in terms of absolute financial impact, but you need to understand their impacts on the firm, as assuming that they have happened. And I think actually it helps us as practitioners to engage with management and say we're not in this for just purely calculating financial impacts. We're looking at impacts, and actually think your worst. And then we can help pick the bones out of that and channel the results into financial results if we need to, but most practically into, so what are we going to do to improve matters? How are we going to improve resilience? Driven from control, given from preparing for failure, all the good operational risk disciplines and business continuity disciplines that we all know and love. So yes, I think this is actually both the push to have scenarios better understood, more widely used across firms, having almost a sort of standard agreed set of scenarios for that firm that are used for multiple regulatory purposes. I think is a great step forward, and again, I support it, and I think it's excellent for us and excellent for the business.
Yeah, so thank you for that, Bill. I can completely echo what Bill says, and that the key impact deep dive is outcome focused. So I feel it aligns well with the concepts of operational resilience as set out by the Bank of England and the Basel paper that Bill has alluded to. So to give an example of using KIDD in the context of operational resilience, so instead of focusing on financial impacts, as Bill says, and as I've done in the video, you would instead focus on IT systems or payment system outage durations. So the impact would then essentially be measured in terms of, let's say, how long the outage is, and perhaps also the number of customers and colleagues that are affected.
Yeah, I'm just going to add one further thought. I think it ends up in a really healthy place, because when you think about the impacts, you start to think about mitigating controls, not preventative ones. And I think if you focus too much on preventative, you're aiming for kind of zero tolerance, which is unrealistic and financially often doesn't make any sense. So you're investing in the right place with your mitigation strategies.
Yeah, I totally agree with that. And I think for me, one of the powerful things that can come out of the resilience exercise and the approach being taken, which again is largely driven by the scenarios, the identification of vulnerabilities and what you need to do to come back in with intolerances, is identifying those critical resources as well, which I think KIDD can help you with. And one of the things I think, is if you know what your critical resources are and you know which important business services they're involved in, you're probably saving yourself several hours, because again, I think we've all been in the situation where something's failed and everybody's looking around saying, well, what's the impact of that? There's often the obvious impact, maybe your payment can't go out of the door, but quite often there's other impacts that you come across as you're trying to solve the problem. So I think I can see KIDD as a really helpful way of, you've done a lot of that pre-thinking, which actually allows you to recover better.
Yeah.
I'll say if the event occurs, because obviously we don't want it to occur, but it is going to occur at some point. Does that make sense?
Absolutely.
And I think you also mentioned there, Philip, around some of the other aspects, and I guess cybersecurity is one of the biggest threats. And I believe there's industry-wide scenarios potentially coming up to test people readiness for that.
Yeah.
So again, Bill, I think you talk sensibly about having one set of scenario that can complement each other and be maybe used for multiple purposes within the organization, so you're not duplicating work. Could you see something like the KIDD methodology being applied, I guess, beyond just a single firm, but actually it could even be powerful across, I don't know, an industry or a sector to make sure that things are joined up through the different types of financial services companies and the infrastructure as well? I am thinking of cyber particularly, I guess.
I would find that difficult to see happening in the next few years unless there is greater industry collaboration. And I think one of the challenges is we're all very focused on our own firms, and yes, we will have cross-industry collaboration at a possibly an exercise level, but once it actually then gets into deeper collaboration, I think the competition challenges and protecting proprietary information I think those barriers are probably too big for us to leap over just now. And I think what limited amount I've seen from the regulators, they're not wanting to become the sort of matchmaker in that respect. It's very much up to the firms to get on with things themselves, and if they want to collaborate, do it within the competition rules, but do it for the right purposes. But I think where we could see collaboration coming forward is considering then the sort of systemic failures, whether it was one of the cloud providers or whether it's one of the large outsourced partners. That is where I'm sure it'll be flagged on many firms' risk registers. Many firms will have looked at the scenario of a failure of a large systemic outsourcer, but actually we don't have a plan. And I think that's where that realization that we've all got the same issue and all got the same impacts will push some early action. So I think that's probably the only place I can envisage in the next 12 months that the collaboration coming, and it is effectively the use of the KIDD technique. Everybody realized we've got the same impact, better do something about it. That's not easy.
Yeah, I agree with Bill that at a firm-specific level, it would be difficult to do such a thing because of the challenges you have around sharing data, etc. But I think where this could have some traction is at the regulatory level. So I'll be surprised if the regulators didn't want to undertake such an assessment, because they do have access to all this data, and they do want to understand the overall kind of macro risk to financial stability, etc. So I think it's certainly something the regulator might want to consider. But I agree with Bill. I don't think something you could do kind of at a firm specific level. But certainly you can definitely use KIDD to assess, I think, cyber risk quite effectively. And I think actually in a video I potentially talk about this. Cyber has clearly many potential impacts associated with it, be it, for instance, deposit outflows, loss of systems, and so on and so forth. There's so many different impacts. And rather than kind of sitting there thinking, dreaming up stories around, how did this happen? What type of cyber event was it? I think this is a case where you do need to spend more time actually thinking about, okay, what if that impact actually occurred, if an impact actually occurred, and what could that actually look like? What could a deposit outflow look like? And what could a data corruption impact look like, etc. So I think there's definitely a lot of work you could do in the cyberspace in terms of applying the key impact deep dive.
Okay. So I think time is almost up on the panel session. It's flown by. I don't know, maybe final thoughts from the three of you? Do you have any kind of maybe final thought after the discussion?
Yeah, final thought. I'll come into the comments that Bill and Philip just made. I've probably got a slightly more optimistic view of the industry, because I think when I talk to people, they do feel that the conditions that lead to adverse impacts can be quite similar in a range of institutions. What differs is the scale, sometimes the number of customers, and the controls. So I think there's a baseline of information that would be really helpful for people to share and use, but then you have to mold that to your own institution. So maybe we're saying the same thing, but coming at it from slightly different points. But I do think, like I said at the start, I think thinking about scenarios in terms of drivers and data is the way to go. It allows you to do trigger-based things. It allows you to scale. Allows you to go back, rerun things when the numbers have changed. It's just a much more sensible way of going about scenario analysis.
Okay, thank you. Bill or Philip?
I'm picking up Luke's point. Yes, absolutely. Use all the resources, use the information you've got to hand, both external information and also the internal firm. But keep it straightforward. I don't mean simple, keep it straightforward and pragmatic. None of this is rocket science. But it's just, you know, if you've got the right format and you've got the right engagement and you've got the right understanding of the business processes and the drivers and the critical parts of the process, you'll get a much stronger level of engagement from the business leaders and a much better outcome to both the workshop, but also then the documentation of the outputs, which then flows through into however you want to use them. And what's the end result? Keep the end result in mind, whether it's capital calculation, improvements in risk management, just stronger understanding of vulnerabilities and creating actions. Keep that in mind, but keep it straightforward with discipline.
Yeah,
okay.
Yeah, totally agree with that. And just the final thought for me would be, it would be great if the operational risk community could give KIDD a shot and try implementing it in their firms. The broader risk community can also think about how it can be applied to other risk disciplines such as credit risk and market risk, and indeed in stress testing and reverse stress testing.
Okay, so I'm going to say thank you to all of you. I think finally, Philip, am I correct in thinking that a paper should be published on this fairly soon if it hasn't been already? Is that right?
Absolutely, yes, indeed. I think in the Journal of Operational Risk in a couple of months' time or so. Apologies, I don't have the exact date.
That's okay. With COVID, I don't think any of us have exact date. But no, definitely. And I think I've had a sneak preview. It's an excellent paper.
Thank you.
And I think very much worth a read when it does come out.
Thank you very much.
Thank you to everybody. I'll let the panelists go now, and I'd just like to spend a few minutes just explaining a little bit about the Institute of Operational Risk, if that's okay. So Bill, Luke, Philip, thank you very much. And Philip, thank you very much for sharing this with us.
Thank you very much. Really appreciate the opportunity. Thank you.
Thanks.
Bye.
So thanks again, I think, to excellent panelists. I hope you really enjoyed that. I found it very useful. I think the timing is excellent as well, with everything that's going on with resilience, with recent events in the world as well. So I'd just like to spend a couple of minutes just explaining about the Institute of Operational Risk, which is now part of the IRM, one of the group companies. So the IOR itself was founded in 2004, and it's really a professional discipline around operational risk. One of the things I will also mention that was a very pleasant surprise, I guess, is looking at LinkedIn, which I'm trying to come to terms with as a bit of a novice, that there is the IOR group on there, which I think has over 9,500 members. So again, I think that is a naturally growing community. So the IOR joined the IRM group in 2019, and I think that is a very positive thing. There are now active discussions going on around how can, I guess, both the IOR and the IRM benefit from this, which is excellent, and we're looking at a strategy on that to take it forward. One of the things that has already occurred is that Professor Simon Ashby, together with sponsorship from SWORD, the GRC system, have updated 9 sound practice guides, which have been refreshed and published, and which are a very good practical basis that has lots of excellent information in there. Obviously, with COVID, events have become virtual, which in many ways actually is good because we have a wider reach that way. So going forward, we do have some other webinars on the horizon, which will be published, and we're hoping by the end of the year to maybe have some physical events again. But thinking very much that we'll actually probably want to have a virtual element within those, because it does allow attendees who might not be able to make it at that time for whatever reason, might not even be in the country but have an interest, etc. So just to mention the certificate in operational risk management, which I think is growing. It has I guess more and more people, I think, are appreciating this, including employers. It is a very good basis on this. So this is available. There's some information here. If you want to know more about this, then it's a question of visiting the website. It is popular. You know, and some of the benefits from here is that, you know, people are getting onto a common page. One of the things I've always found is that, particularly within operational risk, that people can use maybe different theory, different phrases or different descriptions, but actually it's for the same thing. So maybe understanding around that, being able to feel your way around the discipline. And for firms, it really does allow people to move forward. I think operational risk is growing in stature, it's growing in maturity, and it really is an exciting time. I mean, I've spent essentially the last 30 years in operational risk. A large part of that was before it had that name. And one of the great things about it, a huge amount of operational risk is actually grounded in common sense. But then it's how do you evidence it? How do you monitor that to make sure that things are progressing as they should? When something does go wrong, because that's a fact of life, you actually learn from it, you know. And as someone, or very many wise people have said, it's better to learn from other people's mistakes. So with that, I'd like to say thank you very much. Hope you've enjoyed this recording. It's the first time we've done this kind of event, in inverted commas. Hope it's worked well, and it's maybe something we can do again in the future and release. So thank you very much. I'm looking forward to the next event.